Welcome to Volatility Trading Strategies. So hopefully you've had a chance to view some of my other videos and are more or less aware of the growing popularity of investing in volatility. Despite the fact that we're currently in the midst of the second longest bull market in history, 100 months and counting now, the average investor out there has still been left frustrated by the relatively low growth rate of their retirement account. Equities have done reasonably well, but bonds are not that exciting, and gold took a major hit several years ago and hasn't really recovered yet, and even some commodities are dragging. Oil took a major dive, and it's left the 5-year performance of active fund managers and hedge fund indexes right in that same 4 to 5% range. And I don't mean to be the bearer of bad news, but things might not get much better going forward. With stocks near all-time highs and interest rates near all-time lows, it's not that hard to envision a scenario where neither one of them performs very well going forward over the next decade. So for people who are open-minded and willing to entertain new possibilities, investing in the various volatility products that have hit the market in the last several years has been really exciting. It's not that uncommon to see double-digit growth, and in good years, 40-50% or more. But I feel like whenever gains like this are possible, it's only natural and maybe just human nature for people to get too aggressive with it and to start over-allocating in hopes of building wealth quickly. As a more conservative investor, I find it unfortunate that, for the most part, that's how this space is being marketed. In my opinion, there's way too much emphasis being placed on shooting for outsized gains, and not nearly enough focus on what could be a tremendous opportunity to reduce risk. So in this video, I'm going to demonstrate how volatility products, which are inherently dangerous and do display some pretty large day-to-day moves in both directions, I'm going to demonstrate how we can use them to actually reduce overall portfolio risk. So let's get into it. Now, of course, all investors are going to have a different portfolio allocation depending on their own risk tolerance. But speaking in general, I think it's a fair statement to say that the majority of investors have equities as their largest allocation. For anyone who's ever shown interest or asked me questions about index funds, I always point them towards the VXX, which is the Vanguard Balanced Index Fund, and it's made up of 60% stocks and 40% bonds. This is a pretty standard allocation, and of course, if you're looking for index funds, you can't go wrong with Vanguard. Instead of the VXX, though, for this example, I'm going to use 60% S&P 500 using the SPY, and 40% 7 to 10-year US Treasuries using the IEF. So let's see what this portfolio allocation looks like. These results are, of course, entirely during a strong bull market, so it's not a realistic long-term representation, but this is pretty good. It's better than the majority of active fund managers and hedge funds out there, so it's a great start. But as long-term investors, we do always have to keep one eye forward to the next inevitable recession. This isn't a market prediction of doom and gloom here, it's just the natural market cycle, so at some point in the future there will be another downturn. Taking an average of the subsequent declines of the 6 longest bull markets in history, I think it's a fair assumption that stocks may fall about 50% when this amazing run is all said and done. It might be less, of course, but it could also be more. This is just an average. And with interest rates near all-time lows, we shouldn't be expecting bonds to perform as well as they did in the past during the next recession either. So let's make another assumption for the sake of this example and assume that 7 to 10-year Treasuries, the IEF, will go up 5% during the next recession. So if equities drop 50% and a person has 60% of their money allocated, that may be about a 30% portfolio-wide decline. If bonds pick up some of the slack and go up 5%, with that 40% allocation, that'll be a 2% portfolio-wide increase. The net result, this portfolio may suffer something in the neighborhood of about a 28% decline. So this is just an estimate, of course, but it is in line with what we've seen in the past. The VXX, which really is one of the better ones, it suffered a 35% drawdown during the financial crisis. And the recession before that, it saw a 28% decline, so it really is in line with our estimate. So now I want to show you how volatility products, which on the surface certainly appear to be a larger risk asset than the S&P 500, can actually be used to reduce portfolio risk. Now we're looking at a comparison. The blue line there is still that same 60% S&P 500, 40% 7 to 10-year Treasuries. But the red line, instead of allocating 60% of the portfolio to the more aggressive asset, we're going to take that way down to just 15% and allocate that 15% to the XIV, which is the Velocity Shares Daily Inverse VIX Short-Term Futures ETN. And the remaining 85% is still in the same 7 to 10-year Treasuries fund, IEF. As you can see, the performance over the same time period is slightly better. Now we'll call it a draw because it's quite close, But now if we go through the same simple calculation as to what we can expect during the next recession, you'll see the potential power of volatility products. The largest drawdown for the XIV since its launch was 74%. This happened during the European sovereign debt crisis in 2011. However, if we use some simulated backtest numbers for what might have occurred during the financial crisis, there's potential for a drawdown of about 90%. If that happens again, the 15% allocation to the XIV after suffering a 90% drawdown would be a 13.5% portfolio-wide drop. 85% of the portfolio is in the IEF, which we're assuming goes up 5%. This portion of the portfolio may increase 4.25%. The net result here is a drop of just 9.25. That's potentially 3 times lower than the 60/40 fund, which we calculated at a 28% decline. So as long as there's regular rebalancing taking place to make sure that those allocations stay within that initial range, the 15% XIV, 85% IEF fund is potentially far safer than the 60% S&P, 40% IEF fund. During a bull market, similar performance. During a bear market, substantially safer. Now, the really exciting part about this is that we don't actually have to buy and hold the XIV either. These are really complicated products, and they're not at all similar to the standard ETFs that you're used to investing in. Volatility products don't derive their price based on normal supply and demand dynamics. Instead, they derive their price based on a known method of rolling the front 2 months of the VIX futures term structure. So without getting too technical, what this means is that we can compile a list of volatility indicators to help us smooth out the performance and get more out of it. If the shape of the VIX futures term structure is such a way, take this trade. If it's not, take that one. If the 30-day VIX compared to the 90-day VXV is over a certain threshold, do this. If it's not, do that. And many more examples. We can compile a list of these quantifiable filters and potentially do a lot better than the XIV on its own. Now, this video isn't about my volatility strategy, but I do want to show that same comparison using my system. By understanding the volatility products and how they function, we may be able to make a dramatic improvement to the already safer fund for the XIV buy and hold that I showed before. And the risk-adjusted metrics are much improved as well. A higher Sharpe ratio, higher Ulcer Performance Index, lower maximum drawdown, and only a 3% correlation to the stock market. Now, my volatility strategy has seen a maximum drawdown of 26.5%, so there is some up and down movement there. And let's say a 50% drawdown is possible. Now, we do trade the VXX as well, and hold cash over 50% of the time, so strong bear markets may actually be quite manageable. And it could even be profitable. But let's assume that what happens to stocks happens to the strategy as well. Even if it did, it's only a 15% allocation. So portfolio-wide, that would only be a 7.5% decline. And the 85% bond allocation may get some of that back. The end result may be potentially better results in bull markets, with a lot less risk in bear markets. Now, this certainly isn't a recommendation. For me personally, full disclosure, I fill out the rest of my portfolio with my other non-correlated trading strategies. ETF rotation, option trading. I'm not a buy and hold investor. I don't hold stocks or bonds in the long run. But this example is just meant to illustrate that we don't need to view volatility products only through the lens of high risk, high reward trading. There's definitely going to be many people out there who roll the dice, over-allocate, maybe throw on some leverage, and treat it like a get-rich-quick strategy. And that might work in the short run, but I personally don't believe that that's a sustainable long-term plan. But with a change in perspective and an eye to safety and risk management, investing in volatility products can be a valuable addition even to the most risk-averse investor's portfolio. So if you have any questions at all about this topic or some of my other videos, feel free to reach out anytime. I'm always here to help. Thanks for watching. So go ahead and click the link right here, sign up for the VTS newsletter, and when you do, you're going to get full access to all of my trading strategies for a full month absolutely free. And if you are new here, please consider subscribing to my channel. Also, if you have any questions or comments, I'd love to hear from you. So go ahead and leave those in the comment section below. See you next time.